Hey everybody, Tyler and I are going to talk about some stocks that we are planning on unloading from our portfolios. I'm in kind of spring cleaning mindset, even though it's not the spring, it's the end of year cleaning mindset, because that's the best time to do it in your stock portfolio, especially if you have some losing investments. But before we get into that, take a minute and check out the link you see on your screen for a message from our sponsor, The Motley Fool. You get the top 10 stocks to buy right now, and it's the best way to support this work we're doing on YouTube. So, I know, Tyler, you've already sold a stock. We'll get to that in a second.
I've
There's
sold a
one in
lot
my
this year.
portfolio.
I've sold a lot this year.
Tyler is sitting on a lot of cash right now, it's fair to say. He is like the Berkshire Hathaway of stock investors.
That's a
Um,
compliment I don't know if I can live up to.
he's waiting to pounce and fire his elephant gun, as Buffett puts it. So, one stock that I'm planning to sell maybe by the end of this year is Goldman Sachs. And this is a stock I've been very bullish on for a while. Ticker symbol is GS, by the way. I bought it's not an old position in my portfolio. There's a lot of stocks I've owned for a long time. This one I started buying at the COVID lows in 2020, 2021, and I bought a little more in 2022, but relatively recent position. And my thesis was had a lot to do with their consumer banking business. So you can probably see where this is going. So at the time I bought shares, the consumer business was kind of thriving. The Marcus lending platform was doing well. They just jumped into the credit card business and scored Apple, the biggest get a new credit card issuer could possibly have. And they recently had taken over GM's credit card business. My general thesis was there's no other bank that has that combination of a rock solid legacy brand name combined with the cost structure of an online bank. And that was kind of the thesis with Goldman that they were going to really build out their consumer banking, and management wanted to as well. They had, their CEO David Solomon had mentioned things like mortgages, like offering checking accounts, like offering insurance products, and other pretty much anything your bank does. Goldman wanted to offer, and at the time, consumer banking made up about 2% of their revenue. So I saw a pretty big opportunity there. Now, and then they had the core business that is just best in breed, and still is. There's their investment banking business that is really well positioned to do well as M&A activity starts to ramp up again. You're starting to see some more high profile IPOs. There's the trading desk, which is their bread and butter. They have their asset management business where they make their own investments. They have a wealth management business with over $2 trillion of assets under management. The core business is undeniably strong. The new leadership, David Solomon took over as CEO for Lloyd Blankfein a few years ago and really went all in on consumer banking, and the execution has been just poor. Not only did the Marcus platform essentially shut down, they're still doing savings accounts, but you can't get a personal loan from Marcus anymore. Apple just announced, or it's been reported now that Apple is looking to get out of its credit card relationship with Goldman, which to me that's kind of the last straw in the consumer banking business, really unwinding. Um, and I like their core business, but not when it trades for a higher valuation than the other banks that I like better. Right now, Goldman trades for about 12 times forward earnings, about 1.1 times book value. Right now, I can get Bank of America at less than book value. So I see better opportunities in banking right now. Poor execution by new leadership, but a great core business is really the only reason I would stay in the stock. So it's one that I think I'm going to get rid of. And Tyler actually already sold one that I own, and he's causing me to pay a little more attention to it. Tyler, which stock are you getting? Did you just get out of?
So the stock that I sold is Iron Mountain. It's a we'll call it a specialty REIT. It's this hybrid of physical record storage. So literally just they own warehouses where they have just boxes and boxes where you can keep your physical records of, the dentist office or your Fortune 500 company. It's been a very profitable business, and they've ventured a little bit more into kind of taking that physical storage and gone to digital storage with data centers and some ancillary products associated with it. This in no way, I think, is an indictment on the business itself. I think there's actually the physical storage records business is a very durable one. I think that in terms of data centers, they've done a relatively good job. They've, been building out and actually, doing construction versus maybe overpaying for new assets, like some other people may have done recently in the past couple of years back when data centers was hot. The thing that has just given me a little bit of pause with Iron Mountain is valuation has ticked up to levels that are probably a little bit less reasonable than what the future expected returns are for this company. And at the same time, leverage has started to tick back up a little bit. This was a business that a few years ago, everyone was running scared because it looked like it had a lot of leverage. Its debt to EBITDA was somewhere in the mid six, or trending actually even up towards 7 times EBITDA. And so when you see a number like that, you get a little skeptical, especially with a slow growth business. But that has, growth has accelerated because of data centers, but that leverage is ticking back up again after they said they were going to try to get down into the mid fives range. And so with that higher bit of leverage and a dividend yield that's the lowest it's been since 2013, it's starting to look to me like maybe it's a little bit overvalued. And one thing that I've kind of learned over the past couple of years is if the story starts to deteriorate a little bit and it's very richly valued business, it's okay to sell and revisit it later. I've probably ridden a couple too many stocks down when the situation deteriorated, and my returns have suffered because of it. And so this was maybe a little bit of an overreaction on that end of me just saying, look, you've had a very good run with this particular company. Let's take our take profits, I guess you will, or and revisit this company maybe when valuation looks better again. But at this current valuation, I felt like I could deploy my money elsewhere and get a better return. And that's more or less the case. Not really an indictment on the business, than just valuation.
Yeah, that sounds a lot like the reasons I'm planning on getting rid of Goldman. I just feel like I could deploy the money better. It's not that I hate the business or anything like that. In Iron Mountain's case, it's a company that I bought years ago. I paid a lot less than it currently trades for because I people just didn't really see the transition from physical record storage to digital record storage playing out favorably at the time, and they've executed beautifully. I think would be fair to say. A their data center business was kind of an afterthought at that point, and now it's really a significant revenue driver and a significant growth driver. But as I've said, I'm in the same boat as you. It's a very profitable investment for me. It's actually become one of my largest investments just because of how well it's done. And it's one that I'm going to take a longer look at. Maybe not necessarily get rid of it entirely, but reduce my position because I still like the business. Once again, thank you so much for joining me. Be sure to click subscribe if you don't subscribe to my channel already. And as always, this video is sponsored by The Motley Fool. Be sure to visit www.fool.com/Frankel to receive the top 10 best stocks to buy now.